Welcome back to another episode of Freedom Finance with Lanny, guys. I'm back another week in a row coming out with some content for you guys. And based on the feedback, I wanted to talk about the recent journey on generating $1,000 in option premium income in 2025. Again, I teased it in the welcome video that I got into a little bit of option generation here. Again, nothing that's too significant, nothing that's too risky, as we'll get into it. So I wanted to talk to you guys about it as another update with where I've been and what I've been up to, guys. So on today's video, we're going to talk about what type of options I'm writing to generate this option premium income, why I'm even doing it, the goal that I set, and just trying to figure out how to get from point A to point B, but hopefully breaking it down for you, showing you the proof in the pudding, and even the returns on some of them that I'm actually receiving on it, guys. So grab your favorite beverage, your coffee, your beer, your wine, your liquor, because you're Italian this weekend, baby. And let's dive into generating $1,000 in option premium income. Let's get it. All right, so generating $1,000 in premium income. First off, how did that goal come to be? Well, I've done options before, whether that was right after my MBA in finance. I thought I was savvy, and I did them successfully in the very beginning, right out the gate, but very volatile for sure. But recently, over the last few years, I really focused on two types of options that I'm writing and selling. First, if you own 100 shares of a stock, you can do covered calls, which is selling the option to a buyer to buy a stock at a price, at the strike price at the expiration. If the price ultimately is at or above the strike price, the buyer will exercise it. But really recently, there's the second type of option that I've been doing, which is the cash secured put. So I've been, writing and being the seller of these. So what exactly is the cash secured put? Again, we're going to focus on just that because that's where most of the option premium income that I'm receiving. So again, we're talking about the types of options, the cash secured put. So that's what's going to be the focus here, guys. This is me selling the option on a stock at a specific maturity of the option at a specific strike price. So for instance, what's a good one? SoFi stock. One that I wrote, a handful of weeks back. I think SoFi was trading under $11 a share. And I personally felt like the price was not going to go lower and it was actually going to go higher. But the market sentiment was that it was going to go lower. So I sold a cash secured put for $9 strike price with an expiration of May 16th. And so somebody was willing to buy that option that I wrote. So I sold it. And why do I sell it? Because I get a premium on that. So I sold it and actually generated, I believe, $35 on that cash secured put. So $9 strike price times that by 100 shares. So I had to have $900 in cash set aside to sell that put, because if on May 16th, if SoFi's stock price was at $9 or below, I would be forced to buy it at $9. So the buyer actually thinks that the stock price is going to go way below $9, so that, again, they'll end up making out because they're going to sell it for $9 to me when the stock price could actually be at 7 or 6 or 5. And then I would be in a large unrealized loss after buying the 100 shares at $9 per share, if that makes sense. So somebody is betting that it's going lower, and I am betting that it's going to stay the same or go higher than where it's currently trading at, or at least finish above the strike price. So my goal is to, even though I would not mind buying SoFi stock, because I love SoFi, my goal is to essentially be out of the money, or have the price on the cash secured put be above the strike price, so I can keep the premium and then use the cash again to write another one, guys. So in easy terms, again, the cash secured put is I make money from a buyer where I sell a put option, and I would have to buy the put. I would have to buy the shares, 100 of them, if at the end of the option life, again, I usually write them out no longer than 4 weeks. If the stock price is at or below that strike price, I would have to buy the 100 shares. And my cash, when I write it, is set aside and it's locked in on that cash secured put, if that makes sense. So my capital is committed. Now, the things I need to consider is the return on it. I won't write a cash secured put unless the yield on that, unless the return on that will be significantly above a high yield savings account, which again, you can get 4 to 5% still right now in the market. So I usually try to go for nothing lower than a 25% annualized return before tax on it, because then taking on that risk just isn't worth it, if that makes sense. So again, my goal is to not have to buy the shares, for the stock price to end at, or not even at, but above that strike price, so I can keep the premium and then use the cash again to write a new one. So how have I done in just options in general? Well, I'm filming this here on June 1st as I look down at the calendar, and I've generated over $190 essentially in option premium income, so I'm almost 20% there. About 166 of that has been from cash secured put option premiums. And what platform am I using? I actually use the public.com platform. I wanted to keep the accounts separate from my taxable investing, from my other sort of investing. Obviously, SoFi actually doesn't even offer level 1, so I'm using public because it's free. There's no contract or option fee you have to pay to the exchange, which is great. And in fact, there's actually a net positive rebate you get. So if you're interested, highly recommend. It's very simple, probably the easiest option platform, or is the easiest option platform I personally ever used. Public.com. I believe if you sign up, again, I'll put the link, it's going to be in the description. If you sign up, I think there's a sign up bonus, possibly some shares of stock, or I think you even get a larger rebate on writing options if that's what you're interested in. If you do sign up, let me know, keep me posted with how it goes for you, but I could not recommend public.com as much as I am, because I think it's been a very, very easy and fun platform to use to do this part of my journey. I wanted to share some examples as well. I'll put some screenshots of options that I've written. We'll go through 2 examples just so that I hope that it helps you understand what I'm doing, why I'm doing it, and the benefit, the returns of me doing it. So for example, on May 19th, I think it was a Monday, Kohl's, ticker symbol KSS, they had an earnings coming out in about 2 weeks from that date. I think it came out on the 29th or 30th of May. I decided to sell a cash secured put. The price that it was trading at the time was $8.56, and I sold a cash secured put at $6.50. So I had to have $650 of capital set aside, $6.50 strike times the 100 shares. Now, I always like to find stocks that it takes a big drop to get to even that strike price, because the chance that it actually does get there is remote, right? So $8.56, and for me to buy the shares, it would have to drop to or below $6.50 in a 2-week time frame, because the expiration date to this one was May 30th, so 2 actual weeks, 2, 5-day workday weeks. And that was a 24% drop that the stock price would have to have. So I said, okay, this is a pretty remote chance that this would happen. Now the premium that it gave me was 11 cents, but you times that by 100, so $11.01 is what I earned. So in 2 weeks, $11, I'm making $11 on $650 of cash. So when you take that and you annualize that out over a year, that was a 47.43% annualized return on that $650 for that 2-week blip. So what ended up happening, Kohl's finished strong, finished well above $8 a share, had a pretty okay earnings. So I kept the $11.01, didn't have to buy the shares because they finished above $650 on May 30th. And then now I'll have the $650 to use again on June 2nd or whenever I wanted to write another cash secured put. Another example that was a higher, I guess, more of a, not to say a higher risk, was SoFi. When I first started on public.com to write cash secured puts, on April 21st, I wrote one. I actually wrote two, but we'll just show the one as an example. On SoFi stock, it was trading at $10.60 at that time, and the strike price was actually at $9. And I set it for a longer period of time, about the maximum that I'm comfortable with, which was May 16th. So if you actually look at it, it's a little over 3 weeks, right? I guess to reach the end. We'll just call it 4 weeks though for simplicity, right? So about 4 weeks from April 21st to May 16th. Now, $10.60 is what they were trading at, and the strike was $9. So it was only a 15% drop that they needed to go through for me to buy the shares, which I was okay with doing if it happened, but that was not the goal. Now, what ended up happening on May 16th? Well, it expired out of the money because I think the stock was at like 12 or 13 bucks plus per share. And the return, actually, the premium I made was 35 cents per share, or $35.01 on the $900 of capital. So that annualized out, when you extrapolate the 4 weeks to 52 weeks, was 54.46% return on that cash secured put. So just in those two options I talked to you about, one was a 47% return from Kohl's. This SoFi example was 54%. My floor is a 25% return, and I'm willing to go up to, obviously within reason and risk. Probably I've done around 75% returns so far in cash secured puts in the last few months. I'm starting late, obviously mid-April. We're filming this here on June 1st at night, so I've got 7 months to go to generate almost another $800 from here on out, using about $3,500 in capital on the public.com platform. So that is the cash secured put, guys. We talked about what type of options I'm doing. Right now it's really focused on cash secured puts. My goal of $1,000, really it's great from a learning standpoint. I'm not risking too much capital, $3,500, and to generate $1,000 off of that, when you do the math, we're talking 30% plus returns right there, guys, from just working with $3,500. And then on top of that, again, we can then set new goals for 2026 with the experience I get from 2025. Maybe we'll tack on another 0 to that, which would be pretty freaking wild, guys. So there we have it. Let me know if this helped you with me actually showing some screenshots, showing the returns, the calculations, and breaking it down into basic terms. I'm not doing hundreds of thousands of dollars. We're literally talking about a $900 cash secured put position, a $600 cash secured put position. So again, just really trying to get down to earth with it and making it hopefully easy for you to understand. If you have questions, let me know below. If you want me to dive deeper on a certain part of this, let me know in the comments as well. Like the video, subscribe to this channel, guys, and I'll catch you on the next one.